Welcome back to the deep dive. This time we're gonna tackle something pretty intense that you all flagged for us. Uh, the U.S. stock market took a real tumble during the week of March 10th to the 14th, 2025. So, yeah, we're talking a serious downturn.
Yeah, a lot going on there.
And we got a weekly market report here that breaks down the big moves. So anybody who follows the markets, this was a wild week. So we're going to try to cut through the clutter, figure out what really shook things up.
Absolutely. I mean, this wasn't just a little dip. There were a bunch of, I guess you could say, a confluence of factors that really kind of pushed things downwards. And anyone trying to understand where the economy is right now this week is a good snapshot to look at to really I guess figure out what's going on.
Yeah, for sure. So to kick things off, let's just jump right into the numbers, right? Because they definitely tell a story here. We saw red pretty much across the board. Major indices were all down. Dow Jones Industrial Average, it fell 3.1%, ended up closing at 42,252.95. The S&P 500, that was also down 2.3% to close at 5,841.96. And last but not least, the Nasdaq Composite, that closed down 2.4% at 18,789.31. So, yeah, pretty rough week overall.
It was definitely a week where things really shifted, I think. And when you look at the report, you see that it puts these numbers into context. For the Dow, it was the worst week they'd had since 2023.
Wow.
So that's quite a change. The S&P 500 had already been kind of on this downward trend, right?
Yeah.
This was actually the third week in a row where they saw losses, and they even dipped into correction territory for a little bit there.
Correction territory means basically that the index has fallen over 10% from its recent peak, and the Nasdaq, it's still up if you look at the long-term trends, but it's also down quite a bit from that December peak. Yeah, so it wasn't all just a straight shot down, though, was it? The report actually mentions that towards the end of the week there was a bit of a recovery.
Yeah, that's right. On Friday, both the Dow and the S&P 500, they actually bounced back a bit. And the report suggests that this is probably due to what they call bargain hunting. Basically, investors, they see these stocks that have dropped in price, and they see it as an opportunity, right?
Right, they see it as a deal.
Yeah, exactly. They're hoping to, buy low and then hopefully ride that rebound. But it's important to remember, and the report really emphasizes this, that this little rally, it wasn't enough to actually erase all the losses from earlier in the week.
Right. Yeah. So let's get into the meat of it, right? Like, what were the big factors that were pushing things down?
The report points to a few things, but I think maybe the biggest one was the tariffs, right? The escalation of the tariff policies. That was definitely a major driver of this negativity in the market. It was President Trump, his decision to impose those 25% tariffs on goods coming from Canada and Mexico, and those took effect March 11th. And at the same time, he also doubled the tariffs on Chinese imports. So that brought them up to 20%. And this really spooked the market. And the report points out that Trump actually confirmed these measures on Monday. So there was no more waiting around to see if anything was going to change,
Right.
It was happening. So I think what this really shows is just how sensitive the global economy is to these changes in trade policy, and how quickly, investors can lose confidence when these established trade relationships get messed with.
Right. Yeah. So for people who might not be super familiar with how this all works, like how do tariffs actually translate into the market losing money?
Well, got to think about the companies, right? When tariffs go up, it means that the cost of importing stuff, it goes up, and that can really squeeze their profits. And then ultimately those costs might get passed on to us, the consumers. So we end up paying more for stuff.
Right.
And that could lead to less demand, less people buying things. And then on top of all that, these kinds of protectionist measures, they often lead to retaliation from other countries.
Makes sense.
Right. So they might put their own tariffs on stuff that the U.S. is exporting. So now companies that rely on international trade, whether it's importing parts or exporting finished products, they're suddenly facing this much tougher situation. Everything's more expensive. It's harder to do business. And the report specifically says that these concerns were a big reason why the market started selling off.
Higher costs and trade wars. That's not Nobody wants to see that. Okay, so the report also mentions mixed economic data as another factor that contributed to this downturn. So what were the key pieces of data that really stood out here?
Well, the economic news that week, it definitely added to the uncertainty. Like on Monday, the ISM manufacturing PMI came in at 47.2,
Yeah.
and just as a quick reminder, anything below 50, it means that manufacturing is contracting.
Right. Yeah.
So this was basically saying that, factory activity, it was slowing down.
Not a good sign.
No, not really. And then on top of that, we also saw this unexpected drop in construction spending in January. So that was even more evidence that that economic growth might be weakening. So all this data from that week, it kind of shows how complicated things are right now. There are these pockets of strength, and then there are these signs of weakness, and it just makes things very uncertain for policymakers and investors.
Right. Yeah. Yeah. Definitely. So, and then of course we had the jobs report on Friday, which is always a big deal, right? So, what did that tell us?
Well, the jobs report, it was kind of a mixed bag, like the report says. So the economy did add jobs, 175,000 to be exact, but that was actually less than what a lot of people were expecting. They were thinking more like 200,000.
Okay.
But at the same time, the unemployment rate, it actually went up a little bit to 4.2%. But here's the interesting part. Wage growth, it actually came in higher than expected.
So fewer jobs added than we thought, unemployment ticking up, but wages are growing faster. So how does the market make sense of all those seemingly contradictory signals?
Yeah, that's the key question, right? So, stronger wage growth. I mean, on the surface, that sounds good for workers, right? But it also makes people worry about inflation. If wages are going up faster than productivity, then companies might have to raise prices to keep making money. And that can keep inflation going. And this could then make the Federal Reserve, the Fed, less likely to cut interest rates aggressively. And that's something that the market generally doesn't like because, higher interest rates can make it more expensive for companies to borrow money, and it could potentially slow down the economy.
Right. So it's a tricky balancing act for the Fed, right? Keep inflation under control without causing a recession.
Exactly. So instead of, giving a clear direction, the jobs report kind of just added another layer of complexity to the whole situation.
Yeah. You muddy the waters,
Yeah.
so to speak. Okay, so the report also mentions that there was a bit of a positive reaction to some inflation data. So what happened there?
Yeah, so on Wednesday, the Consumer Price Index data, the CPI data, came out, and it showed that inflation had actually cooled down a little bit. It was 3.3% year over year, down from 3.4% the month before. So this was seen as a good sign, that maybe inflation wasn't quite as bad as some people were afraid of. And the report even mentions that this news actually caused the S&P 500 and the Nasdaq to rally a bit.
But it sounds like that optimism didn't last very long. So what brought the market back down?
Well, yeah, the positive feelings, they kind of faded pretty quickly. Those worries about the tariffs and just the general, outlook for the economy, they came back and they kind of overshadowed the good news about inflation. So I think this really shows how connected all these different economic factors were during that week.
Right. Makes sense. Another big thing that the report talks about is what they call tech sector pressures. And they specifically mention Nvidia. So what was going on there?
Oh yeah, that was a big part of why the market started selling off, especially in the tech sector. So there were these reports that came out saying that Nvidia, which makes these advanced AI chips, they were still managing to get their chips into China, even though the U.S. has these export restrictions.
Right. Yeah.
So this made people nervous. They were worried about potential problems with regulators, both for Nvidia and for the whole semiconductor industry. And then there were also these concerns about maybe U.S. companies losing their competitive edge if Chinese companies can still get their hands on this cutting edge technology. And it's amazing how quickly those reports about Nvidia affected the whole sector.
Yeah. So that triggered a pretty steep drop in semiconductor stocks overall, right?
Exactly. The report talks about this big sell-off in semiconductor stocks after those Nvidia reports came out. But it wasn't just about that specific news, right? There were also these more general concerns about about the valuations in the tech sector. Tech companies had been doing really well for a while, and some investors were starting to wonder if the prices were too high, especially with the economy, maybe slowing down. So this led to people shifting away from those high growth stocks.
Makes sense. So with all these different forces at play, how did the various sectors of the market do? The report actually breaks it down sector by sector. So let's go through that.
Yeah, and it really shows how investors were trying to protect themselves, like moving into safer positions. So the sectors that got hit the hardest, they were the ones that were most exposed to all this bad news. So technology, as we talked about, that was down a lot, around 4%, and semiconductor companies, they were really leading the way down there. And then consumer discretionary, that also fell quite a bit, about 2.5%. And that probably reflects worries about how those tariffs are going to increase costs, and maybe people will start cutting back on spending, on things they don't absolutely need.
Yeah.
Financials, that sector was down almost 3%, and that might be because people are worried about the economy slowing down, and what that means for loans and things like that. And then industrials also took a hit, down over 2%, and that's probably because of that weakness in manufacturing and all the uncertainty around trade policy.
Right. So it wasn't all bad news, though, right? I mean, some sectors actually did pretty well, or at least they didn't do as badly. So where were investors putting their money?
Right. So we saw investors moving into what are called defensive sectors, right? Like utilities and consumer staples. They both did much better than the others. They were each down only about 0.4%. And the report actually mentions some specific companies like NextEra Energy, which is in utilities, and Procter and Gamble, which is in consumer staples. They saw more interest from investors because people were looking for more stable investments, something that isn't as affected by the ups and downs of the economy.
Right. Yeah. Yeah, that makes sense. It's always interesting to look at how individual stocks perform too, as well as those broad sectors. So the report points out some pretty big drops for Nvidia and Tesla, which I guess makes sense, right? given what we've been talking about. But Marvell Technology, they had a particularly bad week.
Yeah, they did. They fell 20%, which is pretty dramatic. And the report says that this was mostly because they missed their revenue targets. When they released their earnings report, it wasn't as good as people were hoping for, and that just made the negative sentiment in the semiconductor sector even worse. It
Yeah.
really showed how vulnerable that industry was at that moment.
Right. So there was some good news, though, at least
Mhm.
for Target, right? They actually saw their stock go up.
Yeah, that's right. They actually went up 3.2%, which is kind of surprising when you see how the rest of retail was doing that week. And the report says that this was mainly because their earnings were better than expected. So that was a bit of a bright spot in the consumer sector, and it probably contributed to consumer staples doing relatively well. It suggests that maybe not all consumer-facing companies were feeling the same amount of pressure.
Right. Yeah, that makes sense. And then just to round out the individual stock examples,
Yeah.
Bank of America also saw their stock decline, right?
Yeah, that's right. They were down 4.1%. And I think that just reflects the challenges that the whole financial sector was facing that week. All that economic uncertainty, it seemed to outweigh any potential benefits from those slightly higher bond yields. So that contributed to the negative feeling in the Dow overall.
Right. So the report also briefly touches on what was happening in the bond and commodity markets.
Right.
So what were the key trends there?
Yeah, so in the bond market, we initially saw what's called safe haven buying, which means that investors were putting their money into bonds because they're seen as a safer bet when the stock market is shaky, and that actually caused the 10-year Treasury yield to go down a little bit.
Okay.
But then after that jobs report came out, yields actually went back up, and they ended the week at 4.47%. So that shows that people are still concerned about inflation and what it might mean for the Fed's decisions on interest rates. And then in the commodity markets, we saw the price of oil, WTI crude oil, go down. And that was probably influenced by what OPEC is doing with production, and also those worries about demand going down because of the tariffs. But gold, on the other hand, the price of gold actually went up, which is typical when the stock market is down. Investors tend to buy gold as a safe haven during those times.
Right. Right. So to kind of wrap things up here, I think that week in March 2025, it really shows how different factors, like policy decisions, economic data, news about specific sectors, how all of those things can come together and create a lot of volatility in the market. And I think the main drivers here, as we've talked about, were those tariffs, the mixed economic data, which ultimately pointed towards maybe some trouble ahead, and then those specific pressures on the tech sector. And we also saw investors moving into more defensive sectors, trying to find some safety.
Absolutely. And it really highlights, how interconnected the global financial system is. What happens in the U.S. market, it doesn't stay in the U.S., right? It has a big impact on markets everywhere.
Yeah, for sure. So for those of you listening, I think this week is a really good example of how these economic and political forces, they actually play out in the real world in the market. And understanding these dynamics, like how tariffs can affect costs for businesses, how confusing economic data can create uncertainty, how sector rotations work, all of that, I think it's really important for understanding the bigger economic picture.
Yeah, and I think what's really interesting here is how quickly, sentiment can change in the market. I mean, one bad week doesn't necessarily mean that things are going downhill in the long term, but it's definitely a good reminder that that there are risks and uncertainties, and investors always have to keep those in mind.
Absolutely. So here's something to think about as we finish up here. Now that those tariffs are actually in place and the economic data is still kind of painting this mixed picture, what does all this, these short-term reactions in the market, what do they tell us about the long-term stability of the global economy, and what should investors be doing, to adjust their strategies moving forward? It really makes you think about how all these powerful forces are constantly interacting, right?
Definitely.
All right. Well, thanks for joining us on this deep dive.
My pleasure.